Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook. And today is Wednesday, January 24th. I will be your host for about the next 25 minutes. We have a lot going on in the marketplace. We have the major cap, the big cap tech is all announcing earnings this week. We're going into this week and next week getting a lot of news about the markets based off of earnings reports. We also have a Fed meeting not that far around the corner, but not much expected out of that Fed meeting. If anything, the meeting in March is being talked about a lot more than the upcoming meeting. In the upcoming meeting, it's not expected to have much fireworks. They're expected to keep the Fed funds rate at the current rate. In March, the Fed funds futures contracts have been all over the place. There's at one point in time, there was a 70% chance based off of the futures of a 25% basis point rate cut. Now it's all the way down to about a 40% chance, all based off of the economic data that has came out over the last couple of weeks. And the markets just seem to want to go higher. And so as far as the markets are concerned, the markets for quite some time have been pricing in as much as 4 or 5 rate cuts this year at some point in time. I don't think that's likely personally. The rate cut in March is at risk right now based off of the fact that the economy is just doing well. So once again, we're kind of back to the good news is bad news scenario. The consumer has been strong, wage growth has been strong, and those things have really been propping up the market. So very interesting to see what happened in Netflix's. Yesterday, they basically blew out their numbers, came in really strong in subscriptions, came in strong in revenues. And the stock is up actually 11% right now. When we looked at the expected move in Netflix, we were looking at about an 8% move based off of where the options were priced at. We decided to come in and do a skip strike butterfly. Right now, that's kind of working out. It blew through the numbers a little bit. So it really is about the speed at which Netflix was moving. One of the downsides is, and we talked about this a lot on Options Guide TV, is the fact that they announced on a Tuesday, and today is a Wednesday. Obviously, Wednesday comes after Tuesday, and that means that there's not a lot of time decay that happened in the option contracts. So the fact that we went up so quickly kind of hurt the trade to start with. We needed it to go to basically make the one standard deviation or the one expected move, which was about 40 points. Our risk was if it made an 80-point move. And we did put the trade together on Monday, even though we knew that they were announcing on Tuesday after the close. So ideally, in a non-paper trading world, you would have set it up closer to the close. And that's always going to be the case. We're going to look at Google, and Google's going to be announcing tomorrow. We do have Tesla after the market today. So that obviously there's going to be a lot of eyes on that. And Google, I mean Alphabet, formerly known as Google. And with Netflix, though, we have to look at that trade because, like I said, it moved too quickly. After the announcement last night, it actually moved exactly the expected move, which was $40, which was perfect, based off of where our strikes were at and where our trades were at. But you can't trade the options in the aftermarket. And today it's been up just stronger. So if we take a look at the chart, we'll pull up Netflix. So we're going to also look at the PayPal trade, NFLX. And we'll actually let's look at the shorter term here today. Okay. So here's where the market was at yesterday on the 22nd. Today we're on. Let's move it over then. Let's move over more. Okay, so here is. Okay, so if we're going to move down to a minute chart, and let's go 15 minutes, and let's look at where that underlying market started at today. We kicked off at 9:30. We had on the open, we went up to about 585. Then we ran back up to 560. We got as high as in a 15-minute bar, 562. Then bounced back to 558, 550. This high in this market, well, it closed at the end at the bottom of that candle, but 558. And now we're kind of settling in a little bit, right around 554. So on the open here in that first 15 minutes, the opening print or the high opening print was 558, and that would scare you in the trade that we have on, because our max risk was if it got to 565, that's where our max risk was at on the trade. So if we go back and look at the Netflix trade, let's set it up. We have the January 26th expiration. It's 2 days away. The underlying market when we put the trade on was at 485. So if we scroll down, here's where the market was at, 485 at that point in time. We came out and did the 535 strike. That is, we bought that option contract. That was the beginning of our skip strike butterfly. We then sold the 545 contract, and we sold that twice. And then we went in and we bought the 565 contract. So we skipped the 555, which is where the market is at right now. So that's right on the precipice of where our short spread would have been done. Like when we looked at the options playbook, we talked about the fact that you're selling a short spread to pay for the butterfly. And that short spread would have been a 10-point wide short spread. By skipping the standard butterfly strike of the 555, what we're doing is basically embedding it's like we sold the 555 and then bought the 565, which is 1,000-point requirement. And this is exactly where our risk kicks in. If we were short the spread, we wouldn't be okay with it. If we are short the butterfly, we have some protection because if we are in the skip strike butterfly, we have some protection from 535 to 545 because we're long that call spread. But we're bumping up basically against our short strike here. To start with, this trade would be fine if Netflix would announce on a Thursday, like Amazon usually does. They always announce on a Thursday, and we only had 1 day for this trade to live. Well, time decay would have been a huge factor, and now it's just kind of a factor. We just lost 1 day in a 1-week option, but the implied volatility did come down. It was up around 90%. We see it now at about 42%. So that helps us a lot, but who knows if that's really enough to try to make this trade profitable for us. So in this instance, when we did the trade, we were able to get it done for a net credit of 43 cents. We are now, if we bought this back, it's now trading for a net credit. Let's call it $1.50. It's obviously moving quick, trading after earnings. We'll call it $1.50, but we do have a wide spread, so it'd be fairly hard to fill. But there is a lot of volume going on, which makes the options really liquid. So maybe we could fill close to that. We'll say $1.50. So that means on this trade, if you didn't trade out of it this morning, if you didn't get that opportunity because of the way, let's see where that second bar was at. So the second bar finished at its high, and that was 560. So yeah, you didn't really get a chance there. And then we finally had a bar that closed at that 554 on the downside. So you didn't really have an opportunity to get out of the trade as it was flying through your short strike, which is the 545 level. So right now, what I would do on the trade, because I do not want that risk for the duration. Once again, if we had the scenario where they were announcing on a Thursday and these options only lived one day, well, this would have been a much interesting trade. It highlights zero DTE options, and in this scenario, having only one day for the options to live, we probably would be doing pretty good on this trade. Actually, the fact that you'd have the huge rate of time decay, the implied volatility crunch, but now we need to just get out of the trade. I really don't have an adjustment on the trade. I mean, I guess we could look at rolling this, but no, I don't want to do that. So in this instance, we're just going to buy it back. So the closing trade would be, we put it on for a net credit of 43 cents. We're going to have to pay a debit of $1.50. So we come in and we sell. This would be a sell to close. I'm going to hit open because it's a paper trade. It's not a real position. We're going to buy to open, and then we're going to sell to open. And now it's actually back down to a 90-cent debit. So, well, 130. It's all over the place. I think 150 is a valid point. I think that's where we would possibly get it at. And in this instance, we'd be down $1.07 on the trade. So we learned a lot from the trade, and let's actually throw it in the what if calculator. All right. So, well, this is the opposite. We're upside down, aren't we, on this? Yeah, let's go back. Let's flip it. And let's look at the initial position. Sell to open, buy to open. Okay. Send to the what if. All right. So basically, if we put the trade on today, this is where the underlying stock is at. But this was what we were dealing with. We were all the way down here at, where was the number? 485. So we're right around here is where we were at. We said that if it gaps all the way up one standard or the expected move, we'd be landing somewhere around here. And you would see that, and this is very true, this would have been profitable. This would be trading at a profit. And then you're hoping to get a little bit of time decay as it would drift northward and getting close to our strike right around the 545 level. That would be the ideal scenario. But the fact that it blew all the way through and came all the way up to here, this is the way the graphic looks now. And this is actually fairly accurate, probably profit and loss graph. If we hang with this, the markets have adjusted. The implied volatility is in this trade already, everything to go along with it. But if we hang in this trade, our risk is that we could go down to the 565 level, lose the maximum. But now, interesting enough, the fact that we have a few more days left in this trade allows us a little bit of protection if the market were to go on up. So if the market did skyrocket and we still had some time left in this trade and went all the way up to 575, notice we're not at the maximum on the profit and loss. We're not at the maximum loss on that trade because now the time value is helping us. Back here, when we're within the range that we want, within the TP that works for us, the time value hurts us because we need it to start drifting towards the expiration profit and loss graph. And right in here, it hurts. But now that it has gone against us, now it kind of helps us if it continues on up. With all that being said, we did a trade. The market blew away the numbers. Wasn't much opportunity to trade it right in between these numbers, between 535 and 545. We lost $1 on the trade. And that's it. Now, in hindsight, if you looked at this and you knew these were going to be the numbers, well, just buying a call or just buying a long call spread would have been the better trade, flat out. because it moved more than the marketplace was expecting. That means that you would have paid the right volatility, quote unquote. You still would have had a volatility crunch. But if you were looking, depending on the option contract that you bought, let's just say if you were willing to pay up for something at the money, the implied volatility was implying that the underlying stock was going to move 40 points, and the underlying stock ended up moving 60 points. So it moved more than what the market was anticipating after that earnings report. Now, it's still, the expected move always is relative to the Friday expiration. And a lot of times when you hear pundits talk about the expected move, they don't mention that. And there's a lot of difference between announcing on a Thursday and announcing on a Tuesday. And Netflix usually announce on it's usually Tuesday is usually their day, and Amazon is always a Thursday. Google is a little bit back and forth. Apple is a little back and forth too. They're not set in stone on what day of the week they like to announce. So we learned something today. We learned a little bit about how implied volatility affects that option contract. When you're looking at butterflies around earnings, it tells you a lot about a volatility crunch, about time decay, about the pricing. Now, we did it for a net credit. Right now, this is showing a net credit of $1.50 approximately, it's saying 110. So 110 is what when we sent it to the what if calculator, that was the midpoint, and it picked that and used that valuation. But if you're wrong anywhere on the way down, if it went anywhere in this direction, stayed anywhere below 535, we ended up making 43 cents on or $43 on our $1,000 investment for the week. The worst case, it's not the worst case scenario. The worst case scenario is if it actually would have came all the way up to the 565, which would have been 2 expected moves. It would have been 80 points to the upside. That would have been the worst case scenario. That's tough for a stock to do that, but in this day and age in the tech stocks, it's possible. It's possible that it could happen, but not probable. All right. So there is our Netflix. Now, if you have any questions about this trade, we're going to do a few more of these. And as always on Options Guide TV, when we're setting up the trades, we're using things like expected move, 1 standard deviation moves. We're thinking about what expiration that we're going to use. We're discussing what we could think could happen with Netflix. We were correct on the forecast. This is a frustrating trade in that our outlook was correct, but it blew away the numbers. And the stock being up more, almost, 60 points as opposed to 40 points, up 10% as opposed to what the expected move was around 8%. It just kind of hurts the trade. Once again, if we were a little closer to that expiration date, we would be probably profitable. Like we'd have to be right around in here if we were, what is that, the 555 level, somewhere in that range. 550, we'll say if we were at 555, okay? Right about here, we would have broken even on that trade. We would have been just fine if we had even one more day of time decay. You would see that the screen line would morph towards this profit and loss graph right here, the at expiration. All right, I think I'm getting a little long-winded on this. Let's go back now and let's look at our second trade that we're going to talk about here, and that's in PayPal. So with PayPal, we did have an opportunity to get out. We kind of hit the high end of that. PayPal is not announcing it until February, but it got hurt today. So we put the trade on. When we put the trade on, we did a 66 by 69 long call spread, and we did it for a mere 86 cents based off of where the chart was at. So let's pull up PayPal, and we'll have to add some days to the chart. And we'll go out. Let's do 800, and then we'll zoom in. Okay, so we're down in this range, and we had the up day. So we wanted, I don't think, and I mentioned this on Monday's show, unless we got up towards that 69 level, not really sure if we would have got out. The high on this candle for this day was at 68. Then we kind of meandered between 65 and on the low end, it was 64. But now we've definitely broken down on that candle. We still got the 200-day moving average kind of hanging out, and we came down and touched that level. We flew through it. What was this, back on the 19th? So we're meandering. We still got a few days left on this trade, so I don't mind hanging around in the trade, but let's go and set it up. Okay, so with PayPal, let me grab my note here. On the PayPal trade, we did the February 2nd expiration. My eyes aren't what they used to be. Okay, so here's the expiration that we did. We still got 9 days remaining on the trade. We bought the 66, which is here on the ask price. We sold the 69, which is here. We're down 20.70. We're down 16 cents on the trade right now, but it's more so about the fact that we're not getting the breakout to the upside. We had good news in pay. Well, it was kind of consolidating to the downside. Like you could make the argument that, we're trying to catch a falling knife. A lot of the sellers are out of the market. We just saw kind of a strong move to the upside, and we're just kind of hoping that momentum continued. We were a little bit late in that. Would have liked to put the trade on the Friday before, but oh well. Here's when we did the trade, and we ended up with buying this. I mean, I should say it this way. Options Guy TV is on at certain times of the day. Sometimes there's going to be missed opportunities. Sometimes it's going to be beneficial to your trade. The fact that we put it on a little bit earlier, a little bit later than intended. But with that said, we put this on 66. The market's back down to basically where it started. It was right at 64 and change is where it is at. And we're at 73.75. And if you wanted to now, here's where you could make an adjustment. And that's why I wanted to bring it up. I think I'm going to let it ride a little bit in this instance. You only paid 86 cents. We did an out of the money option contract. But here's where an adjustment could come in if you really wanted to do it. But it doesn't bring in a lot of capital. But we're at the right time that the adjustment could work. Okay. And once again, it's the same concept of looking at the butterflies. If I come in or looking at the butterflies and rolling from a butterfly into a short put spread, which we've done a few times in the SPX, now we're in a long call spread. That is, the market is, well, at one point in time, it was pushing up against our short strike of 69. If you missed out on that opportunity, if it would have doubled, I would have gotten out. We were looking at 3 points wide. It was trading for 86 cents. If I could have sold it for somewhere close to $2, I don't know if we could have, but I would have probably got out of that trade. Market is now coming back down. We're down 16 cents on the trade. Total investment on our 1x1 long call spread was 86 cents or $86. Obviously, if you did it on a 10 lot, that's a much different scenario. But so here's the alternative. And I just want to bring it up just to bring it up, because Options Guy TV is all about learning how to adjust trades, how to look at trades, how to explore your alternatives once you get a trade on. So in this instance, we're long the 66, short the 69. We have the February 2nd expiration, which is 9 days away. Make sure it says February 2nd over there. We're still trading at a 52% implied volatility, which is actually within this range here. February 9th, we're getting into earnings. Earnings going to be announced between the 2nd and the 9th. I think it's the 7th is when I think it is, but don't quote me on that. Okay. And then we're going to add, so in this instance, we are going to sell another 69 strike call, and then we're going to buy a 63 strike call. So we're going to embed the short spread that makes all three legs of the butterfly. You're going to be long a 66, long 2 of the 69s, and then go out and buy a 72. So in this instance, let's sell this one and buy that one. Oops. late. And buy that one. 1 by 2 by 1. That's what our butterfly would be at. If we would have put it on to start with, we would have had a 36-cent net debit to the account. But now our trade, we're already long the 66, so I'm going to get rid of that. We have 2 of the 69s. But our trade would actually be to sell 1, and now you're bringing in a net credit of 30 cents to the account. So we put the trade on for 86 cents. Now we take off that, and we have 56 cents is our total net risk to the account, or $56, but we still have a chip in a chair in that we are within this range. We got 9 more days, and if the market can come back and land closer to the 69 level, well, we could still make a potential $3 from our butterfly on the trade. But it's a much more nuanced trade in that if we do blow through the numbers, which we were kind of hoping would happen the first time around, blow through the 69 level on the upside, well, then at beyond 72, it doesn't help us anymore. So this trade is more of, I don't want the cheese, just let me out of the trap. And that's the way that I approach this. If I'm in a long call spread situation, I could just sell it. I mean, I'm not doing too shabby on it. If I sold it, we would be down 16 cents on the trade. Now our max risk is going to be 56 cents as opposed to 16. If we just sold it and closed it out, our max risk would be 56 cents. But we do have a chance to actually get that money back and get out at break even, or maybe even do a little bit better. So let's go in, and you know what? I think let's back out for a second. And I know I'm pushing up against time. We wanted to look at a trade in Netflix or in Google. Let's do the Google trade. Let's go back for a second. Let's do the Google trade. Okay. So Google is going to be announcing earnings, and let me confirm this, tomorrow. And if we look at our underlying stock right now, the February expiration is trading at 42% implied. It's not too shabby, but obviously there's something that's going to happen before the February 2nd date. So Apple or Google, however you prefer to refer to it, we have the earnings date on the 30th. So this is going to happen on Tuesday. Oh, we can wait until Tuesday. Okay, so we got Tuesday the 30th, not the 23rd. All right, so then let's look at Tesla real quickly. So Tesla is tonight. And of course, I'm freezing. So on the Tesla trade, let's what I think we're going to look at doing, and I've already kind of taken a peek at this, taking a second for me to move here with all my technology rocking and rolling. But what we'll do is, as opposed to Netflix, where we went out and looked at a skip strike butterfly that was further out of the money, confirming on that Google date. So that's on the 30th. Come on, chains. I just want to do an at the money long call spread. So we're just going to be bearish or bullish on Tesla. And if you have an opinion, let me know what you think what the way you'd want to go with Tesla. And we'll try to set up the trade that way. But I need Tesla right now is up about 1%. It's trading at 211. I'm not getting my quotes to come up. But everything else is moving. So I'm not sure why. I don't have a good explanation for what is actually happening here. There we go. How come Microsoft kicked in? But I can't get the Tesla quotes to come up. Well, I guess we're not going to have a paper trade today. I'm bumping up on time. PayPal, everything but Tesla. All right. Well, I don't know what to say. Apologize for that, but that would have been the underlying. I mean, Google is next week, so I do want to do a trade on Google. I really was thinking that it was today, not as opposed to tomorrow, or as opposed to next week on the 30th is when Google is going to be announcing, according to Yahoo. I think I should just punt and move on. And it's not coming up. Still not. All right. So with that said, that's it for this edition of Options Guide TV. I apologize we didn't come up with a paper trade today. I know we have a lot of earnings. Anybody got an underlying stock out there that they might want to look at? We have so many different earnings that are going to be coming up this week. But if not, well, let's move on. We're a few minutes past. We have at the end of the week, we have Visa that's going to be announcing this week. Netflix was Tuesday. And then what else do we have? We got IBM that's going to be announcing, and I mentioned that's going to be an interesting one. IBM has been doing well with their information. Tesla after the close. Down today. All right. Well, why don't we come back on Wednesday and we'll look for a different trade. We have a few companies that are announcing earnings at the end of the week. We'll look at something on Friday going into next week. Maybe we'll even look at the Google trade. Google's on Tuesday. We'll probably look at that on Monday. So I'm just going to let it go. Sorry about the snafus. We will talk to you this coming up Friday on the next edition of Options Guide TV. Thanks for coming, everyone.